Welcome to the deep dive. We're jumping straight into the latest from the macro butler, and trust me, it's a spicy one.
Oh yeah, what's the title?
Independent but impotent. The Fed fiddles while the cycle burns.
Wow, okay. Fiddles while the cycle burns.
Oh,
That definitely sets a tone.
it really does. Buckle up, because this commentary takes a, well, pretty critical look at the Federal Reserve's recent moves.
Right, so it's questioning if the Feds really got the steering wheel here or if they're just along for the ride.
Exactly.
Right.
That's the core question the macro butler is asking. Is the Fed in control, or are bigger economic forces just playing out? Our mission today is to unpack their arguments, pull out the key points, and, figure out what this might mean for your wallet.
Okay, let's get right to it then. The FOMC meeting, the Fed kept rates steady, right? 4.25% to 4.5%.
Yep, no change there. Pretty much expected. But the macro butler's take on why is, well, it's cutting.
How so?
They basically called the Fed a guest who refuses to leave the party.
Ouch. So implying they're maybe overstaying their welcome or perhaps too comfortable while things are potentially heating up outside.
That's the vibe. It suggests maybe a reluctance to really tackle inflation head-on, or even fully acknowledge the slowdown risks. The macro butler points out the Fed itself warned about risks from every direction.
The classic inflation versus stagnation tightrope walk.
Right, and they even flagged tariffs as a drag on first quarter GDP growth.
So the Fed sees the issues, but maybe isn't acting decisively.
That seems to be the interpretation. And alongside holding rates, they're still doing that balance sheet trimming, right? $5 billion a month.
Yeah, which, in the grand scheme of things, the macro butler kind of frames it as maybe not enough. A bit like bailing out a big ship with a small bucket.
Except plate ladle, I think, was the analogy they used.
Huh, right. Especially when you look at that chart, they included the massive balance sheet expansion versus unemployment.
Yeah.
It puts the current trimming into perspective.
Definitely. Okay, let's shift to Powell's press conference. What did the macro butler glean from that?
Well, a few things stood out. Powell mentioned the dual mandate. Obviously, jobs and prices.
Standard procedure.
Sure, but the macro butler read a lot into his, let's say, apparent uncertainty when pushed on which goal is the priority right now. They called it a white flag.
A white flag, like
No.
surrender.
Or maybe just uncertainty. Like in central banker terms, it signals they aren't really sure which battle to fight hardest right now.
That sounds not very confidence-inspiring.
Exactly. And Powell also said the committee doesn't need to rush rate changes. The macro butler sees that less as patience and more as, well, the Fed just not having a clear view of where the economy is actually going.
Okay. Any mention of political wins? White House influence?
Powell dodged those questions, as you'd expect. Interestingly, the macro butler noted Powell's own sentiment reading stayed neutral, maybe trying to project calm.
Could be. So, putting it all together, what's the macro butler's final verdict on the Fed's position after this meeting?
They're pretty blunt. They think this meeting just confirmed the Fed's growing impotence, their word, in actually steering the economy. And they reckon the Fed's probably losing the battle against what they call tariff-stoked stagflation.
Tariff-stoked stagflation. That's a mouthful, but it paints a picture.
It does. They even felt the market's positive reaction wasn't, as strong as maybe it has been after past meetings. Perhaps investors are starting to see the limits too.
Interesting. Okay, so that brings us nicely to the market reaction. What did the macro butler observe?
Well, U.S. stocks bounced around a bit, but closed higher. Not huge gaps between the major indexes, though the Dow did slightly better.
And sector-wise?
Winners were things like consumer discretionary, IT, healthcare. Laggards included materials and communication services. So a bit of a mixed picture there.
Gotcha. What about the bond market? How did expectations for future rates change?
This is where it gets really interesting. Despite all this talk of Fed uncertainty, money markets actually trimmed their bets slightly for a July rate cut.
Oh, so they think the Fed might hold off longer.
Well, yes, for July, but they still expect multiple cuts by the end of the year. It's like
Oh.
the market is hearing the Fed's cautious tone, but basically thinking, yeah, but you're going to cut anyway.
So the macro butler says the Fed is uncertain, but the market is still pricing in cuts, almost like they're ignoring the Fed.
Kind of like tuning out the fog of uncertainty, as the macro butler put it.
Okay. And the dollar, gold.
Dollar saw a modest lift, nothing dramatic, stayed in its range. Gold just continued trading sideways.
And the macro butler has a take on that sideways gold action, right?
Yeah, they argue it's investors slowly waking up to gold's role as a wealth protector in an inflationary bust scenario. Their advice, buy the dips.
Noted. and the 10-year Treasury yield.
Still consolidating,
Hmm.
stuck in a pattern for now. But, and this is key, the macro butler expects much higher long-term yields down the road. They think the actions of the Fed and the government are eroding the whole idea of a truly risk-free long rate.
Okay, so that covers the immediate reaction. Let's zoom out to the macro butler's broader thoughts and warnings. They bring up some historical points that are pretty thought-provoking.
Absolutely. They really push back against that common idea that lower rates automatically equal higher stock prices.
Right, that's almost taken as gospel sometimes.
Exactly. But they point to historical data showing S&P 500 forward earnings per share actually often rose during rate hike cycles. And the best stock returns often came after the first hike, not before cuts.
That really does flip the script. Why do they think that is?
Their argument is it's not just about the cost of money, it's about the underlying economic health and corporate profitability. They focus heavily on this ratio, the S&P 500 price relative to the price of oil.
Okay, the S&P 500 to oil ratio, what about it?
They look at it with its 7-year moving average. They argue rate cuts often happen near the peak of this ratio. When the ratio starts trending down and breaks below that average, that's the signal for declining corporate earnings, kind of regardless of what the Fed does with rates.
So that ratio is a key indicator for them, a potential warning sign for earnings.
A very key indicator, yes.
Now, the commentary title mentions independent but impotent. Let's touch on that independence part.
Right. They remind us that, yeah, presidents appoint Fed chairs, but removing them isn't easy. It needs cause, not just policy disagreement. They mention Nixon, Reagan, Trump examples showing the Fed is designed to have some independence from politics.
It's built into the system, even if it gets tested.
And they also bring up a historical cautionary tale. The New York Fed lowering rates in 1927, partly due to European pressure.
And the argument is that contributed to the Great Depression.
That's the macro butler's reading. A reminder that even well-intentioned central bank actions can backfire spectacularly. They also briefly note the Fed funds itself, adding another layer of autonomy.
Right, operational freedom. So given all this, what's their view on rate cuts as a tool to stimulate the real economy, investment and growth?
They're pretty skeptical. They argue businesses invest when they see opportunities driven by things like tariffs, global conflicts, tax policy, government spending, stuff largely outside the Fed's direct control. Lower borrowing costs alone aren't the magic bullet if the opportunities aren't perceived to be there.
Which leads back to their inflationary bust forecast. What does that mean for assets?
In that kind of environment, they argue, both stocks and bonds could perform poorly once that S&P 500 oil ratio really turns down. Their preferred safe haven, gold.
Gold again.
Yep, and they add another warning sign. The S&P 500 to gold ratio is also nearing its 7-year average, potentially signaling a shift there too.
Okay, let's try to synthesize the macro butler's main takeaways here.
Sure, key points are, the Fed's becoming less relevant. Stagflation looks likely due to geopolitics and fiscal policy. Corporate profits are heavily tied to energy costs. Don't count on rate cuts to save the day. Expect a stronger dollar, higher long-term yields, and higher oil and gold prices.
That's quite the outlook. And they also talked about investor behavior in this scenario.
Yeah, they see declining trust in public institutions, pushing investors towards tangible assets like physical gold, silver, platinum. They warn long-duration bond investors and suggest favoring physical gold and short-term, high-quality corporate debt. Generally, expect way more volatility and pretty dull inflation-adjusted returns.
Wow. And they wrap up with a critique of current economic thinking.
A pretty sharp one. They argue mainstream economics ignores crucial factors like global money flows, debt dynamics, and public confidence. They basically call for a new theory, grounded in the business cycle and real-world experience, not just academic models. They use a memorable analogy about someone writing a book on childbirth without ever,
Having gone through it, right. Got it. Drives the point home. So specifically, what are their investment recommendations based on all this?
They suggest a hefty allocation to physical gold, like 30–40%. In equities, focus on low-debt companies with steady growth. They specifically mention buying dips in energy producers and aerospace defense. And for bonds, avoid long-dated government stuff, favor short-term investment-grade corporate bonds.
Okay, so wrapping it all up, the macro butler's core message seems to be a serious caution against relying too heavily on the Fed to navigate what's coming.
Exactly. They see the Fed as increasingly constrained, maybe even sidelined, by much bigger global and fiscal forces.
Which leaves us with a final thought for you, the listener. If central banks might be, as the macro butler suggests, somewhat impotent in the face of these larger trends, what other factors, what other signals beyond just monetary policy should you be paying the closest attention to right now to steer your own course? Something to chew on. Thanks for joining us for this deep dive.